Welcome to Heartofeconomy. We are living through a historic transformation. The recently approved Genius Act in the United States is not just a crypto regulation. This law is actually a declaration of something deeper. Money is no longer solely the domain of the state. What is the Genius Act? What does it actually bring? With the Genius Act, digital dollars known as stablecoins are officially being regulated. But what appears to be a regulatory step on the surface may actually be laying the foundation for a new monetary system behind the scenes. The Genius Act was passed in the US Congress with an overwhelming majority of 308 to 122, becoming the first federal law to recognize stablecoins. So, what is a stablecoin? Stablecoins are digital currencies operating on blockchain technology but pegged to traditional currencies like the US dollar. In essence, they combine the speed and transparency of crypto with the aim of being stable against price volatility. This law officially defines stablecoins and allows them to behave like the dollar, but under clear and strict conditions. Stablecoins must be backed 100% by reserves. These reserves can only consist of cash or US Treasury bills with a maximum maturity of 90 days. Every issuer must be licensed, subject to audits, and regularly disclose financial reports. They must comply with anti-money laundering laws. Consumer protection principles will apply. While these provisions appear to protect investors, they carry a deeper message. The state is opening space for the private sector to create money. And this space is not just financial. It could signify a strategic transfer of authority. Is a new monetary system being built? What is money? A measure of value? A medium of exchange? Or a symbol of sovereignty? This law redefines the answer to these very questions. Now, a retail giant like Walmart or Amazon can issue its own stablecoin. These coins can be used to pay salaries, make purchases, or be integrated into loyalty systems. Stablecoins are no longer just financial tools, they are becoming platform money. And this points to a much bigger shift, one that transfers monetary control to private platforms. This means the production of money is becoming privatized. The structure of money once controlled solely by a central bank is now being distributed to private institutions. This removes one of the core functions of traditional money, being a payment instrument, from the state's monopoly and hands it over to the market. It also proves that money is not a neutral tool, because the one who controls the payment system gathers data, the one who gathers data analyzes behavior, and the one who analyzes behavior doesn't just generate profit, they influence behavior. That's why stablecoins are not just technology, they are an economic infrastructure, a political tool, and a societal mechanism of power. Where does the central bank fit in? How is monetary policy affected? This transformation directly concerns central banking, because as stablecoins grow, the Fed's influence over money supply may weaken. Why? Because even though these currencies don't technically fall under the M2 definition, they functionally replace cash. This means traditional monetary policy tools, like interest rates, might become less effective. And that poses the risk of central banks becoming powerless. Moreover, since stablecoins reserves are mostly short-term government bonds, the government's borrowing structure could be affected by this new demand. This could indirectly make public financing dependent on the money supply managed by the private sector. In short, stablecoin system offers a popular alternative that undermines the central bank's control over the money supply, yet is too popular to be directly opposed. Is the balance of financial power changing? Who will benefit? Who stands to gain from this system? Frankly, big tech and financial giants are currently in the most advantageous position. Institutions like JP Morgan, Circle, PayPal, and Citigroup are already preparing to issue stablecoins. This doesn't just give them the power to create money. It allows them to build their own payments ecosystems. Within this system, customer loyalty, transaction data, and capital flow can all be centralized. This represents a new kind of monopoly, a financial platform monopoly. Even more strikingly, the firms within this system will be able to offer not just payments, but integrated services in credit, investment, and insurance. Meaning, they may have the chance to rebuild the entire banking architecture. Systemic risk. Could we see another 2008? As the stablecoin market expands, one of the biggest questions is this: how resilient are these structures in times of crisis? What happens if a major stablecoin issuer, like USDC, mismanages its reserves or loses market trust? A digital bank run. Everyone tries to withdraw their money at once. Liquidity dries up. Treasury bonds and reserves are suddenly dumped. Panic hits the markets, and as a result, the entire system could seize up. To limit this risk, some academics propose insurance funds, emergency credit lines, central reserve audit mechanism. But as of now, the Genius Act does not foresee these measures. The system is operational but fragile, and that could lead to a new era of too big to fail. Large stablecoin issuers could become so vital that their collapse would require state intervention. Where do technology and regulation meet? This regulation is not just financial, it's a technological revolution. Stablecoins operate on blockchain infrastructures like Ethereum, and this infrastructure is not just for transferring money. It is the foundation of smart contracts, DAOs, tokenization. So, the Genius Act not only governs money creation, it also redefines the legal status of digital assets and the relationship between technology and law. Code is no longer just a programming language. It is a mechanism for regulation economic behavior. And now, these codes must comply with regulation. Technology will not only serve innovation, it will serve as the digital interpretation of law. Politics, money, and power. Conspiracy or reality? Trump signed this law with a major media show, but behind the scenes, some claims are surfacing. Companies like Circle and Tether are said to have lobbied figures close to Trump, raised funds, and influenced the drafting of the bill. Moreover, the presence of advisors who have worked for stablecoins firms raises the likelihood of conflicts of interest. These claims are not yet substantiated, but in a time when money is being rewritten, it seems unrealistic to assume politics will stay completely uninvolved. What do other laws say? The Clarity Act and CBDC ban. Alongside the Genius Act, two other bills were also passed. The Clarity Act defines which crypto assets are securities, SEC, and which are commodities, CFTC. The Anti-CBDC Act bans the Fed from issuing a digital dollar, CBDC. Taken together, these laws paint a clear picture. The state is stepping back, and the private sector is moving forward. This isn't an ideological stance, it's a structural direction. A new financial reality has begun. The future of money is no longer being shaped within the walls of central banks. The new order is now being forged in Wall Street boardrooms, Silicon Valley presentations, and the closed doors of Congress. The Genius Act may only be the first line of this new era, but who will write the lines that follow? Who will own the money? The answer is not yet written, but it's too real to ignore. If you want to stay ahead of this transformation, understand the deeper dynamics behind the headlines, and see what others miss in the future of finance, subscribe to Heart of Economy now. This is not just a channel, it's your front row seat to the economic shifts that will shape the next decades. Turn on notifications, be part of the conversation. Don't miss a single update. What do you think about the Genius Act? Who should really control the future of money? Leave a comment below. We are reading all of them. Thanks for watching. See you in the next video.